This is the view from up here. I like it. My name is Michael Del Castillo. I'm a journalist at CoinDesk. We are on stage today with Albert Wenger from Union Square Ventures and Naval Ravikant from AngelList, amongst many, many, many other credentials. In fact, as a result of the nature of our conversation, we're going to be talking a little bit about, first of all, kind of getting comfortable with the idea of what is a FAT protocol, and then get into some of the side effects of this concept, in particular, the nature of app coins, as they were at one time called and now go by a slightly different name. Before we get into that, though, I wanted to take a little bit of time to establish why it is that these gentlemen to my left here are perfectly suited to sort of go through these series of concepts with us. So first of all, I'd like to ask each of you if you could kind of briefly review a little bit about your investment portfolio, as is the public investment portfolio, as it relates to what we might call a FAT protocol or an app coin. Just to give us an idea of what you find interesting and maybe use it a bit as a talking point to kind of define what these concepts mean.
Thanks. Yeah, I mean, I got into these FAT protocols back in 2013, a little bit later than some of you, but earlier than others. And to me, what's compelling about them is that they're a force for creating market economies, where before we had internet protocols that essentially treated all resources as free. So you could think of some of the applications that are coming out as successors to HTTP and TCP/IP and SMTP and all the things that made the internet great. And then also as a way to decentralize systems that have inherently been highly centralized, everything from central banking to rights of way. So I think we're entering an era where, thanks to decentralized consensus and blockchains, we can create markets and everything. And unlike the last generation of technology creation and venture capital, a lot of these protocols will actually capture value because of tokens. So my investment thesis has been to invest in the fundamental layer 1 blockchains in the space. I actually do it out of a little a little hedge fund called Metastable, where I'm a venture partner, and I kind of helped start it along with Albert, who was one of the founding LPs. And I'm also an investor in a whole bunch of little companies in the space, like Blockstack and Zcash and Protocol Labs and others. And then also with AngelList, we're also getting involved in the space by helping create some regulatory cover for high-quality ICOs.
So Albert, by way of your curriculum vitae, just a brief little review of some of your investments in the space before we get into the nuts and bolts of what it actually means.
Yeah, so maybe before talking about the investments in the space, I think for context, it's useful to say that at USV, we've been investing in the web, broadly speaking, since 2004. And we've had a lot of success with investing in centralized systems and centralizing systems such as Twitter. We were first investors in Twitter and Tumblr. And we've had a lot of fortune, made a lot of money by investing in network effects. And I think one of the things we have become concerned about is that network effects, in a way, are too powerful when they are controlled by one entity. So I think relatively early on, we were quite interested in the idea, how can companies be good stewards of the networks that they operate? And we then sort of, when we first got involved with Bitcoin, which was through our investment in Coinbase, we began to understand that it was now possible to have decentralized state. I think the reason why the web tended towards centralization was because HTTP as a protocol is a stateless protocol, and that means somebody's got to maintain state. And yes, you can maintain state in the browser, but the reality is people maintain state on the server. And so at the end of the day, Facebook is a gigantic database, a database of usernames, friend lists, and status updates. Amazon is a gigantic database of credit cards, purchase histories, and SKUs. And so we got very interested in how these protocols could be used to create decentralized versions that didn't have a controlling owner. And so we've invested in, among others, Protocol Labs, Blockstack, Obi-Wan, and we continue to be looking at other opportunities. And as Naval mentioned, I invested personally early on in Metastable, but we're also now an LP as Union Square Ventures.
And so using those brief lists of investments as examples, could you talk to us, you've already kind of started to flesh out the difference between the fat protocol, and I guess we may as well call this the skinny protocol. In concrete terms, based on the companies that you have identified are personally interesting and worth your own time and capital, how do those investments exemplify what a fat protocol is?
Well, maybe we should still try and define the terms very briefly, because maybe not everybody fully sort of understands why we're calling one thin and the other fat. So Sir Tim Berners-Lee did the world a huge favor by creating the hypertext transfer protocol, but the deployment of the protocol was not incentivized directly, and there was no direct way for him to make money off the protocol. In fact, he's made fairly little money off its existence, even though all of us use it, and underlying protocols like TCP/IP came into the world the same way. So there had to be extrinsic economic incentives to go and deploy these protocols. And the protocols themselves didn't capture any value. The value capture happened in entities such as Twitter, Tumblr, Etsy, Facebook, et cetera. And so the big contrast now is that now we have protocols that have economics built into the protocol. And so we have a totally different model for two things. One, for how to incentivize the initial innovation, the protocol creation, and then how to incentivize the deployment of physical hardware and capacity against the protocol. And so we believe that in that world, much of the value will reside in the protocol, in the tokens, and then the applications that sit on top of it will be quite thin and won't be able to capture much value as a result.
And so when you talk about the value residing in the protocol, in the tokens, I think that's probably a great opportunity to open up to Naval the idea of the token. Some people give you credit for coining the term AppCoin. Some people give you credit for popularizing the term AppCoin, but you were definitely there at the beginning. Could you sort of briefly walk us through what it was that you visualized when you first started using the term AppCoin, and how is that similar or different to what it is that we're actually seeing being played out?
Yeah, so this was back in 2014 when Bitcoin, or 2013 when Bitcoin was really the only one out there in force. And the idea was that I looked at it and said, wow, this is a much better model for crowdfunding. Instead of having lots of bankers and lawyers and this infrastructure of a company, you can be an anonymous person or group like Satoshi Nakamoto. You can code this thing up, you can release it to the world, you can keep back 10% or whatever, pre-mine or even early mine. And this is a whole new business model for open source software and networks. And so then I thought others would come up, and I just call them app coins. But I think the term that's actually stuck is altcoins, which is a little more pejorative, but fine. You know, the market votes with its time and words. The ways in which it's been similar is lots of people are using this as kind of the new crowdfunding. And unlike the crowdfunding that is normally approved by regulators in most parts of the world, this is available to anyone. So they don't have to have US dollars. They don't have to be accredited. There's no bank in the middle that says, no, you can't take a certain amount of money per day or how to regulate that. There's no custody required around the securities. The custody happens in the blockchain. So all of a sudden, we've gone from these very small, limited financial markets to this completely global, anonymous markets that are available to everybody. So that part of it is definitely played out. What I've been surprised about is the speed and ferocity with which it has played out. I don't think anybody really anticipated that. Bruce Fenton had this great tweet recently where he said that it took 7 years for the entire cryptocurrency market cap to get to 10 billion, and it took 1 year after that to get to 20 billion, and it took 3 months after that to get to 40 billion, and now his tweet is less than 3 weeks old, and we're now at 80 billion. So I think next up in 3 days, we should have the singularity.
Well, and the great thing about these exponential curves is that when you look at them at one moment, they look really steep, and then when you look at them a year later, that thing looks just like a small blip. And personally, I'm very much in the camp where 80 billion will still look like a small blip when we look back.
I think long term this is absolutely true. I feel like we're in kind of a 1997 to 1999 moment in this technology, and history never quite repeats, but it often rhymes. So I don't think necessarily it'll end the same way. But even during that time period in the internet, where I think both of us were around, there was a lot of
We're old.
Yeah, we're old. There were a lot of bad investments. Actually, I remember right in 2000, one of the famous license plates or bumper stickers basically said, "Dear God, please give me one more bubble. This time I will know what to do." So I think we are going through a phase of irrational exuberance, but long-term rational exuberance, because I do believe that over the long term, the winning blockchains will end up being worth trillions of dollars. I mean, the gold supply is worth somewhere between $7 and $11 trillion, and as long as you know how to use Bitcoin, it's been around for long enough that you can trust it, it is much better than gold than almost every conceivable way. So we are going to end up with the winning blockchains, and there will probably be more than one of them that are worth trillions of dollars. So in that sense, I agree with Albert.
And I want to just quickly pick up on that comment, which is that for every important new technology, we've seen an initial wave of irrational exuberance, and that wave was incredibly historically important. So we had this with railroads, we had this with the early days of computers, we just recently had it with 3D printing, and the reason these sort of bubbles are incredibly important is because that's where the systems are built on which then actual new activity takes place. So a sector needs to attract a lot of capital early on for technology to get out broadly into the world. And I think we're in that phase now, and I think this phase will continue for some time, and a lot of technology will get created. How much of that will ultimately be used, I think it'll be probably a relatively small fraction, but you can't get to the right small fraction without trying a lot of things. And so I think people always say, oh, there's too much activity happening. No, there's no such thing as too much activity happening. We need to try lots and lots and lots of experiments to find the few things that actually matter.
Could you talk a little bit about the functionality of the coin as it relates to the protocol? What is it about a distributed, decentralized protocol that sort of almost as an emergent property gave rise to the existence of these coins? Is there an intrinsic value? Is there a need for these coins as relates to the concept of a fat protocol? Or is there a less nuanced relationship?
Well, it definitely depends on the coin. I think some of the coins out there today are basically just look like standard venture-backed businesses where somebody has slapped down a token so they can do an ICO. But I think on the good blockchains, on the good protocols, you basically have some scarce resource underneath. And the Bitcoin blockchain, it's a concept of money, it's credit. In the Ethereum blockchain, it's compute power. In the Storj or Filecoin blockchain, it's storage and availability. So you have a scarce resource. You need to allocate that scarce resource, and for that, there has to be a coin. These are fundamentally also making markets. So in the storage example, more supply will be added as the coins become worth more because the people who own the storage want to trade them for these coins that are worth more. So the idea of blockchains without the associated coin is sort of very hard to imagine. It's a very, very narrow use set at that point. You're just talking about a very inefficient database for the most part.
Just to give maybe pick an example that isn't sort of broadly thought about at the moment, but why is it that when we use our cell phones, we need a carrier? Well, because the carriers were the ones who built the network. And how did they finance the network? Well, they financed the network by raising money in the capital markets, because they had to build cell towers first before they could provision the service, before they could charge us. So the cash flow pattern was such that they needed to spend money first before they were going to get paid by us cell phone customers. That's been the historic pattern on a lot of things, and it meant they had to go to the financial markets again and again until they were cash flow positive and until they could finance towers out of those things. Now, in a token world, and we could all think of, let's say, trying to replace much of the cell infrastructure with a mesh network, right? Well, how are we going to get people to start provisioning nodes for the mesh network? Well, one way to do that is to have a token that you can earn when you provide capacity to the network. And now all of a sudden we have created a decentralized mechanism that doesn't rely on the traditional capital markets to get investment in capacity going. And that's why this is such an important new innovation, because we have a decentralized accumulation of physical capital detached from the traditional financial markets. That's really, really important to understand. Historically, when you wanted to put physical capital into the world, which, by the way, is the only capital that matters, financial capital is an immediate state. You don't clothe yourself in dollar bills. You don't drive in a car made of gold bars, right? It's physical capital that matters. And historically, in order to accumulate physical capital, you needed financial markets, and you needed to have access to those financial markets. Now we have a way of incentivizing the production of physical capital, the deployment of physical capital in the world without going to the traditional financial markets, and that is a huge, huge innovation.
The tokens themselves seem to have two characteristics that I want to kind of spend a little time thinking about. One is as a store of value, and one is as a piece of a machine. In other words, they serve a functional value to the protocol in which they are designed to serve. I've heard frequently, as we're waiting for formal decisions to be laid down from regulators, that this functionality is crucial to separating the token from a security. First of all, is that an accurate understanding that the functionality of the token makes it separate from a security? And second of all, when you are making investment decisions, how do these two, the yin and the yang of these token properties play into your decision making?
Yeah, I think I'm not a lawyer, so I'll let the regulators and the lawyers sort that one out. But definitely for the tokens, it varies. So for some of these tokens, the use case is very strong, such as like a storage-based token, like a Filecoin or one of the others. Those are allocating storage in the network, and you needed to use the storage piece. Something like a Bitcoin is a lot more like a gold, where most of the value is in the store of value component. But that doesn't mean that there's anything wrong with that. If you look at commodities, even oil, there are a lot of times, especially in financial crisis, financial shocks, when the majority of the value in oil is not in the use case, it is in the store of value component. I think the regulators are going to have a hard time sorting this one out, but the nature of this market is that it's global and distributed. A lot of companies have already moved overseas. A lot of the people who are funding these things are overseas. If the US wants to kind of, or any jurisdiction wants to block it out or regulate it under the old system, what they're basically doing is they're making sure that the next generation internet will be built overseas. In the US, we've enjoyed this one huge advantage that I don't even think we understand. We just take it for granted, which is that everybody in the world uses our Google, our Twitter, our Facebook, and most of the value from those flows to us. So the US government, the US people, the US culture gets all this inordinate sway over the rest of the world. I don't think we're ready for a world where it happens kind of in reverse.
And in the Web 1.0 world, we actually did a lot of regulatory things that helped foster adoption. So among other things, for instance, we didn't have a sales tax on the internet for a long time, and that helped with the adoption of e-commerce. We wound up trying not to have a lot of state-by-state regulation on what you could do online, and that helped a lot, gave us a big single sort of domestic market for US internet companies to grow in. So I think we got a lot of things right in the Web 1.0 world, and I think in this turn, I think it's very important that regulators approach it in a similar way to the way they approach that, which is to say, there's an innovation happening. Yes, it has some characteristics of securities, has some characteristics of currencies, may have some characteristics of a pre-purchase of a product, but it is not the same as those things. And so let's figure out what this thing is, and let's figure out how it operates in the global context, and let's figure out how we can be pro-innovation, while also thinking about the things that regulators rightly think about, which are things such as fraud and which are things such as people losing their life savings. Those, I think, are legitimate concerns. And I believe it's possible to address both of those, to be innovation friendly and yet also make sure that people aren't sort of putting their life savings into something that turns out to be a scam.
Yeah, I think the regulation has a role to play in disclosure for sure. Right now, there's just not a lot of disclosure going on. The conflict of interests are not revealed. But I think if we are building a global stock market instead of a local stock market, and it operates at all levels when companies start and when companies are at the end of their life cycle, and it's liquid the entire way, then I think that is an incredible innovation. And that market is going to probably create a lot of financial wealth, which will eventually lead to real world capital allocation and wealth. We should do that. We should support that. But we should do it in a way that disclosure is paramount and people know exactly what they're buying, what they're getting into. And this space, it needs research, it needs market making, it needs coverage, it needs critical thinking. I mean, that'll come in one of two ways. Either the regulators will help enforce that, or people will lose money the old-fashioned way, and then they'll become more careful.
The disclosure point, I think, is absolutely critical. So one of the things that's happened is that now that we have the internet, we should be regulating things very differently from how we regulate them pre-internet. Pre-internet, you needed to say, you're a not-for-profit, you're a for-profit company. You're a private company, you're a public company. And you needed to then prescribe rules. If you were in one of these buckets, you had to behave this way. If you were in this other bucket, you could behave in a different way. Why did we have to establish these categories? Because information was very expensive. So we could check in on how companies or not-for-profits were behaving like once a year, 6 months after the year had closed, when they provided their printed annual report, right? Today, you can see things in real time as they unfold. So today, the way we should regulate things is if you want to be a public company or if you want to have a token, here's the transparency standard you need to adhere to, and then you're good. Similarly, if you don't disclose a lot, no matter how big you are, you're considered a private company. That's the approach we should be taking. We should be taking a regulatory approach that avails itself of the same technology on which all this stuff runs.
But so until that happens, are there any rules of thumb that you are applying when you are doing the due diligence on the companies that you're looking at? Going back to that comparison of the store of value versus the functionality, are you investing in one particular kind of token? Do you require that the tokens have certain characteristics before you will put your money in them? Are you mindful of what you might eventually not be allowed to say out loud because it could be perceived as an endorsement? Or do you feel safe on this side of the regulatory silence and just kind of explore and experiment willy-nilly?
Well, we do think it's very important for the types of tokens that we're interested in that they have application value in the protocol, that they aren't like, oh, we have this great idea, we can't fund it, so let's do a coin sale over here and then somehow have a hand-wavy white paper and then retrofit this thing over there, maybe or maybe not. That's definitely not the kind of stuff we're interested in. We're interested in things where there is a very clear technical roadmap where the token plays an integral part in that technical roadmap, as Naval mentioned, where it addresses some kind of scarcity or some other sort of consensus finding function that's required for the decentralized system to maintain state.
Naval?
Yeah, I think Albert put it really well. You basically look for what you think are going to be important use cases, like for example, you might say a prediction market or a storage network or a compute grid, and you form a thesis around a set of those. Then you look at the different projects in those. You say, who are the best teams? Have they written the code? I actually think in this market you have to review the source code, especially if you don't have direct contact with the developers, because I think a white paper is one thing, but code is law in a sense. So you have to review the source code. You have to have a sense of, is this going to be the winning token in that space? And then will the value actually accrue to the token? Because there are cases where you could win, but the value accrues to a different token if you're built on top of another token, or it could just leak out the back door in a completely different way. And fundamentally, I think this decentralized versions will actually beat the centralized versions because there are tokens out there that are still quite centralized, either in terms of their development teams or the ultimate control from that development team. So I think it's a really hard problem with the 700, 800, 900, whatever tokens are out there. There's probably 5 more launching while we're having this conversation. I think there's maybe like 10, 20 max that I would take a serious look at.
I'm glad you mentioned the due diligence at the code level. I think famously that did not happen on a massive scale with the DAO. There was, I don't remember anyone ever mentioning code due diligence before that collapsed. The distributed autonomous organization, I'm sure everyone in here knows, that had some less than perfectly written code that ended up resulting in some exploitable problems. Are you running the code before you invest? Are you asking people who are coders to look at it
yeah,
for
I'm not
you?
good enough anymore to read code. There was a long time ago when I might have read some code, but not this level. So I let the metastable team do it. They're really good at it. I mean, obviously, you need a real expert. But yeah, I think fundamentally that level of diligence is required. One way you can think about the DAO, by the way, is there was a bug bounty on that smart contract, and the bug bounty got claimed. And at some level, every coin is a bug bounty on the implementation of that protocol. Zcash is a bug bounty on a brand new set of untested cryptography or less tested cryptography around ZK snarks. They're very complicated. They're saying, hey, if we get this, then we have private blockchains, but this is really difficult. Let's try it out. And if somebody finds a bug in here, it's worth quite a bit of money. Same with Bitcoin. The longer Bitcoin has been around, that means that $20, $30 billion bug bounty has not been claimed, and which means that you can trust it even more. And there will come a day when it will have been around, or something like it will have been around for so long that you will be able to trust it as much or very close to as much as gold, and it will have many advantages. At that point, it'll be a multi-trillion-dollar blockchain with a multi-trillion bug bounty. There is an argument that you can never prove something is completely secure, right? You can always prove you can always show that it's insecure by breaking it, but you can never prove that it is secure. And so therefore, one could argue that just because of that, there will always be multiple tokens that are stores of value, because you don't want to put all your eggs in one basket. Ideally, in fact, you want to have ones that are as different as possible.
And I would add that I think early failures are an important aspect of all innovation. Early buildings collapsed until we figured out how to build them so they don't fall down. Early airplanes fell out of the sky. So this is to be expected, and I think it's really, really important that we don't take failure cases and point at them and say, bad, but rather say, yeah, that happened, and what did we learn from it? And I think people learned a lot from the DAO. So I think it's to be expected, and I don't think it'll be the last one of these things to go wrong.
So the simple fact that you guys have people to test the code for you is kind of indicative of, I think, a crucial difference between the institutional investor mentality that existed prior to the ICO phenomenon, and that distinguishes you from the other money that is flowing into this ecosystem. I had a fascinating talk with both of you earlier about the idea of dumb money, and what to do about it and what not to do about it. As the institutional investors in the room who have people that test the code for you, what do you see as your role in this growing economy with what may or may not be an increasing percentage of dumb money going into it? Do we, as a community of people who are studying it, have a responsibility to adequately communicate that to those who aren't studying it and maybe putting their money in? Do we let them just fall and learn on their own? Or do we ask the government to step in and basically register?
Well, if there are flaws in the code, let's be generous for a second. I think almost all the flaws that are in the code are real bugs. They're not malicious. So the government can't do anything. The government's not going to debug the blockchain, right? So that's not going to happen. So I think it's just different levels of sophistication, and people will take an early risk after they've done the diligence. In a sense, this is not a popular thing to say, but Ponzi schemes have been around since the dawn of time, and money is the bubble that never pops. If we had all gone along with tulips, and that tulip bubble had never popped, we'd be carrying tulips in our pockets, and we'd be trading tulips right now. But tulips make for lousy money, so instead we use other kinds of currencies. But these are all systems where they just they need time, they need to grow, and they get adopted first by the smart, sophisticated people who basically validate it for the next crowd. So the classic Ponzi scheme works with suckers, right? You go and you find the dumbest person in the network, and you get them to then go and sell it to someone smarter, and it eventually fails because then the rest of the audience is too smart and they're not buying. Here it's almost the opposite. The first people who can adopt these things are the cryptographers and the scientists and the mathematicians. And frankly, it's kind of nice to watch them make a little bit of money for a change, given all the value they're adding to our society. and technology. And then after that, you can get sort of the more sophisticated people who are in finance, but also understand technology. And then I think it gets more and more ready for the masses. Dumb money versus smart money, I mean, everybody who's already in likes to call everybody new as dumb money, right? If you're already in, you look smart, and everybody new looks dumb. So that definition just keeps changing. So I don't want to use those kinds of terms. But I would say if you're going to put money in this space, you should be very sophisticated about it. You should talk to the really smart people. I would not go trading, jumping after trends or hot money or, or even purely indexing into the space. I would really do deep diligence and analyze the coins to whatever extent you can. And I would only put in the money you're willing to throw away, because in some sense, these are all still very deeply out of the money call options. And so, you want to be in a situation where you can put the money in and just forget about it. And the best investments I've ever made, especially in this space, but has been true in general, is where I have been intellectually curious about the thing in the first place. So if I'm intellectually curious about the thing in the first place and I think it's useful, then I will do the homework. I won't even consider it work. So homework is a wrong word. I'll consider it fun. It's a hobby. I'll learn about it. I'll be into it. And then I will have the courage of my convictions to also put a little bit of money where my mind is.
Albert, is dumb money maybe good for the industry because it's getting people to experiment with the technology?
Well, I first want to take a different sort of tack at this whole issue. The thing that's absolutely fascinating here is if you take a company like Enron, right? Enron was this really complicated house of cards that you really couldn't see anything about, tell anything about from the outside, or very, very little. And it took some very clever sort of forensic people on the outside to go figure it out, but mostly after the fact, mostly after the thing had collapsed. This is a totally different world. It's not just that the code's open source, the protocols themselves exist and are specified. Now, some are more specified separate from the code, some are specified through their reference implementation. But never mind, there's actually a protocol. So you have multiple vectors of understanding what's going on. You can say, well, I like the protocol, but I don't trust this code. It's in a language that I don't like, and that maybe doesn't have the kind of security guarantees that I like. So I'm going to re-implement this, or somebody else is going to re-implement this in a different language. And because this is a global phenomenon, and the globe is full of really bright people, everybody can contribute to this. And so you have sort of two modes of making it better. One is you can just write a critique and put it out on the internet, and if it's a valid critique, people will go and say, oh, that's a valid point, we should do something about that. Or you can write a competing piece of code, or I guess we have three. You can also fork existing code and existing running blockchains, as we've now seen. So we have this incredible, extraordinary open model of innovation. And so yes, things will go wrong, but it won't be in this kind of hidden, behind smoke and mirrors, Enron type way. And so I actually think this is a much more egalitarian opportunity for anybody in the world to contribute to it, and for anybody in the world to point out flaws. And so I actually think the rate of improvement that we will see as a result of this will be and is already extraordinary. So I think this is very important, how this is, because of the transparency aspect, very different from the things that have come before it.
I think we're out of time here. Naval?
I was going to say, one way to think about blockchains is we've gotten to the point in humanity's evolution where no single company, no single group, no single entity can build the next generation of the internet. It's just too darn complicated. So we basically have to open it up to the entire world to co-develop it once and create the financial incentive in the community around it for us to innovate our way forward.
One last thing before we go off stage. If I could ask the audience, anyone who's never invested in any token at all, raise your hand. All right, that's a small percentage of people. Gentlemen, in 1 or 2 sentences, what would you say to the people who raise their hands before they purchase a token?
Buyer beware.
Buyer beware.
I would say buy and beware.
Buy and beware. Thank you both, gentlemen. Thank you very much. Thank you.
Perfect.